Hey everyone, I'm Nick and welcome back. You came for finance, but what we're diving into today is something bigger. Much bigger. On what's now being called Liberation Day, former President Donald Trump triggered a global economic shockwave. With a sweeping new tariff policy, he's shaken markets, spooked investors, and sent financial media into a frenzy. In just hours, trillions were wiped from global portfolios, and yet some are calling this the start of something intentional. What if this isn't just economic chaos, but strategy? What if we're witnessing the opening move in a plan to reset the global financial order, from interest rates to debt, trade policy to national sovereignty? Stick with me because we're going deeper than headlines. We're breaking down what just happened, what it really means, and why some of the smartest minds in finance, yes, even Ray Dalio, say this could be the beginning of a new era. The moment the tariff announcement hit, markets responded instantly and brutally. The S&P 500 fell sharply, with nearly 10% shaved off its recent highs in a matter of days. For many investors, it felt like déjà vu. The optimism of a soft economic landing vanished, replaced by headlines screaming recession and instability. It wasn't just equities that took a hit. Small-cap stocks, typically more domestically focused, were absolutely hammered. These are the companies that often rely on stable supply chains and predictable consumer behavior. With tariffs upending both, they've become ground zero for market volatility. Over in the bond markets, things weren't looking much better. Credit spreads, basically the risk premium investors demand to lend money, started to widen. That's a red flag. When bond investors get nervous, they demand higher returns, signaling that they see more risk ahead. Add to that a weakening dollar and struggling currencies like the Mexican peso, Canadian dollar, and Chinese yuan, and you have the makings of a full-blown global reaction. Corporate America is already showing signs of stress. Layoff announcements are trickling in from industries tied to international trade and supply chains. Business leaders are scrambling to understand how these sudden changes will impact their operations, and many are already lobbying Congress to try and reverse course. But the administration seems unfazed, for now. At the root of the panic is uncertainty. Markets can handle bad news. They can even handle pain if it's predictable. What they can't handle is not knowing what comes next. Right now, investors are trying to figure out whether this is the beginning of a prolonged trade war, a short-term negotiating tactic, or the start of something even more transformative. One thing's for sure, business as usual is over. At first glance, the justification for these tariffs seems fair. Reciprocal treatment. If another country charges us a tariff, we'll charge them the same in return. That's the message coming from the White House. But when you dig into the numbers, the logic starts to fall apart. The actual tariff rates other countries impose on U.S. goods are nowhere near what's being claimed. For instance, China's average tariff on U.S. goods sits somewhere between 6 to 10%, depending on the product. Vietnam's tariffs aren't even close to the 46% that was slapped on their exports. Australia, we imposed a 10% tariff on them, even though they charge us nothing. The math doesn't add up, because the math isn't based on tariffs at all. Instead, the administration used a completely different formula based on trade deficits. They took the U.S. trade deficit with a given country, divided it by the value of imports from that country, then cut the result in half. That final number became the tariff rate. It has nothing to do with actual policies those countries apply to U.S. exports. Let's break it down with an example. The U.S. runs a $295 billion trade deficit with China, and imports $439.9 billion worth of goods from them. Divide 295 by 439.9 and you get about 67%. Cut that in half and you land at 34%, which is the new tariff rate for Chinese imports. This method was applied across the board despite being based on raw deficits, not actual trade barriers. The kicker? These calculations completely ignore services where the U.S. dominates. We export things like banking, education, software, and tourism at a massive surplus. But since those don't show up in physical goods data, they were left out of the equation. It's a move that simplifies a complex problem but at the cost of accuracy and fairness. The response to the tariff announcement was swift and intense. Wall Street went into panic mode, investors pulled back, CEOs started issuing warnings. The business world likes stability, and this was anything but. The press hammered the administration, with headlines framing the move as reckless or economically suicidal. Critics quickly split into two camps. The first believes Trump simply doesn't understand economics. They argue that this is classic protectionism, short-sighted and harmful to long-term growth. According to them, the trade war is a vanity project, not a strategy, and it's being waged at the cost of everyday Americans. But the second camp is more skeptical, in a different way. They suspect that there might be a bigger plan behind all of this. After all, Trump isn't exactly new to using chaos as a negotiation tool. From real estate to politics, he's known for using bold moves to force the other side to the table. Could this be more of the same? It's worth noting that some longtime critics of globalization, even from the progressive side of politics, have echoed similar complaints about unfair trade. Bernie Sanders, for example, has often criticized how countries like China exploit labor and environmental loopholes to outcompete U.S. manufacturing, so there may be more overlap here than you'd expect. Regardless of where you stand, one thing's clear. The administration is playing a high-stakes game. The question is whether this is short-term posturing or the first step in a complete reset of how the U.S. interacts with the global economy. Now let's dig deeper, because this might not be about trade at all, at least not directly. Think about what else tariffs could do. They increase prices, slow down consumer demand, and create market uncertainty. All of these effects could have a secondary consequence. They pressure the Federal Reserve to cut interest rates. Here's why that matters. The U.S. government is on the hook for nearly $1 trillion in interest payments every year. That's just the cost of servicing the debt, not reducing it. High interest rates make that burden even heavier. So, if there were a way to legally, publicly, and politically justify lower rates, that would be a huge win for Washington. Now let's connect the dots. Donald Trump made his fortune in real estate, a business built on borrowing. He understands the power of debt and leverage. He said it himself, you don't get rich with high interest rates. So what if these tariffs are actually designed to tip the economy just enough to give the Fed no choice but to cut rates? Lower interest rates would do more than just ease debt payments. They'd also open the door to refinancing the government's $9 trillion in near-term debt. Imagine the government rolling over that debt at lower rates, saving hundreds of billions. That's not just clever, it's strategic. And there's one more layer. If these policies bring manufacturing and jobs back to the U.S., that creates long-term growth. So while the pain is real now, the goal might be to reindustrialize the country and rebalance the global system. It's economic disruption, but maybe with a purpose. Even billionaire hedge fund manager Ray Dalio sees this as something more than just chaos. In his view, the global economy runs in long-term cycles, and what we're seeing now fits into a pattern of disruption, debt crises, and realignments. Tariffs, he argues, are one of the tools used in these shifts. According to Dalio, tariffs have several important effects. First, they raise revenue for governments. Second, they're deflationary for countries being targeted, because those countries lose exports and see economic slowdowns. At the same time, tariffs are inflationary for the country imposing them, due to rising prices on imports. But more importantly, Dalio believes these policies weaken global economic efficiency while strengthening domestic resilience. That means you trade short-term gains for long-term independence. You might see slower growth now, but you gain more control over your economy in the long run. He calls these moves deglobalizing forces. They're the exact kinds of disruptions that happen when global systems start to fracture. Think of the post-Bretton Woods era, the 2008 financial crisis, or the rise of China. Big shifts like this don't happen often, but when they do, they change everything. So when Ray Dalio says we're entering a new economic order, it's worth paying attention. This isn't just about trade deals, it's about the architecture of the global financial system, and right now, it's being rewritten in real time. If we take all of this together, one thing becomes clear. These tariffs might not be about punishing other countries. They might be about forcing a system-wide reset, economically, politically, and monetarily. It's less about the price of a t-shirt and more about the price of power. There's no doubt this strategy involves risk. The economy could fall into a recession, global markets could retaliate, consumers could feel the squeeze, but from a long-term strategic point of view, this kind of move could help the U.S. reduce its debt, regain control of its monetary policy, and revive domestic industries. The name Liberation Day might sound dramatic, but maybe it's meant to be. In this view, it's not just about tariffs, it's about independence from a system that no longer serves American interests. Whether you agree with the method or not, the ambition behind it is massive. That said, we're in uncharted territory. No one knows exactly how this will play out. Timing matters, execution matters, and public support will matter even more. Because the longer the pain lasts, the harder it will be to hold the line. So what does it mean for you? Stay informed. Don't just watch the stock market, watch the policies. Understand the strategy behind the moves. Because if this really is a reset, then every investor, every worker, and every citizen will be affected. So here's where we're at. This wasn't just a tariff announcement, it was a signal, a shot across the bow of the current economic system. Whether you see it as reckless or revolutionary, it's clear that the U.S. is stepping into a new phase, one where the old rules no longer apply, and the playbook is being rewritten in real time. The fallout won't be immediate, but it will be real. Markets will react, currencies will shift, central banks will be forced to move, and everyday people, investors, workers, business owners, are going to feel the ripple effects for better or worse. But here's the key takeaway. In every disruption, there's opportunity. If this truly is a monetary and trade reset, then those who understand the landscape early will have the upper hand, whether in stocks, real estate, crypto, or global strategy.